Hi, everyone. Welcome to the breakout session for the Sustainable Finance case study and a fireside chat. So we've been having some very interesting conversations throughout the day about sustainable finance, fiduciary duty, where does environmental and social impact come in. But we understand that in order to make it real, we need to ensure that people coming from different walks of life, from academics, in businesses, the finance industry, there is more of a conversation about what really happens when we talk about ESG and disclosure reporting, or all of these terms combined together. So we've actually gotten experts, panelists today, who are going to be really breaking down each of the terms that have been discussed so far. And then we have a case study in a very interactive fashion where we'll actually go through a potential scenario for how these decisions are actually made. So in the first 30 minutes, we're going to be covering some key questions surrounding these terms. We'll also detail the case study, go through those questions, and then we'll move over into the next room where each of you are going to be actually brainstorming what would you have done in that specific scenario in a financial institution, and I'll go into more details about that in a few moments. So before I do that, I'd just like to make a few introductions. So I'm Irshad. I'm the Senior Vice President at ESG Tree. I'm joined today by my esteemed panelists. I'll just make the quick introductions. So to my right is Graeme Blair. Graeme is the Director within the Royal Bank of Canada Sustainable Finance Group. He works closely with RBC's mid-market clients who view sustainability and ESG factors as an essential part of their corporate strategy and investment decision-making process. Graeme has over 2 decades of experience in capital markets and has advised and executed on various M&A, recapitalization, growth capital, and financing mandates. Prior to RBC, Graeme led buy-side engagements for public and private investor group at a boutique M&A advisory firm. So Graeme Blair. And then to Graeme's right is Janice Noronha. Janice is the CEO of JLMN Group, an advisory firm focused on sustainable value creation business models. And prior to her current role, Janice was a partner at PwC Canada, focusing on sustainability and climate change. Janice has more than 25 years of experience in sustainability issues, covering strategy development, program implementation, regulatory guidance, and performance reporting. Janice's sustainability experience covers a wide array of industrial settings with a focus on the mining, aerospace, transportation and logistics, and retail sectors. So thank you so much, Graeme and Janice, for being here today. So when we start the conversation, it's just very important that we cover a few things that make this conversation more important, because ESG has actually been going on, in the public markets for quite a while. But I wanted to take the opportunity to let both of you at least comment on your relationship to sustainability and how your work in the past decades has informed your worldview around ESG and sustainability today.
Okay, thank you. So maybe I'll just start. In terms of my role at RBC, I've sort of spent the last 10 years at the bank executing on M&A deals. The bank has created a number of sustainability finance groups. And the one I sit in is probably the most interesting because it covers sort of the mid-market all the way down to small business. And what really I am charged with is building out that sustainable M&A practice. And not a lot of firms have them. I'm charged with finding companies that are doing things differently in terms of their products and solutions or their innovations that acquirers can take advantage of in order to further their sustainability goals. And sustainability goals are really important to the bank. The bank takes their client responsibilities really seriously. Notice that there was a RBC sign up earlier around oil and gas. We recognize the need for a transition in our economy, and we're putting a lot of resources around that transition. And I'll just mention a couple of quick goals. There are many. One, the bank's trying to deploy $250 billion in sustainable finance by 2025. It is deploying $1 billion in capital for climate innovation and tech by 2030, and the huge one, which is to become a net zero bank by 2050, which means all the clients must be net zero. So our team has a tremendous amount of work, and I think that M&A and private capital have a huge role to play. So I'll turn it over to Janice to provide some comments as well.
Well, great. Thank you, Graeme. So I'm Janice, and I started in the sustainable development field more than 25 years ago. I grew up in Kenya, and I had the opportunity to work at UNEP at a time when the term sustainable development was actually coined. And I came to Canada for many reasons, but one in particular, that when I worked at UNEP, it was actually the Canadian delegation that was driving the sustainable development agenda, the Secretary General, and a lot of the conversations that were happening at an international level, and including the emerging economies in developing countries. When I came to Canada, I really had sort of a broad view of the term sustainable development, and I know throughout this conference, there are different perspectives on what that actually means, but really, it really is a paradigm shift of integrated thinking, where you're really bringing the economic and the financial acumen to address these sort of broader social, environmental, and even governance-related challenges that we face in our world. So I spent about 17 years working at PwC, and a lot of that within Canada and as well in the US was really planting a seed. And part of that was shifting the mindset away from recycling paper cups, essentially, to thinking about this as a business, and a business philosophy that should be embedded into absolutely everything a business does, from how it thinks about its purpose, its core values, the way in which it operates and drives excellence, and how it touches the customer experience, attracts capital, innovates and empowers its people, and ultimately drives performance. And so, fast forward 17 years later, I've had wonderful opportunities to lead a team, to lead businesses, to think out of the box within different industries and sectors. And just very recently, last year, I sort of thought about my legacy and what I really wanted to do. And I decided, took a sort of leap of faith and decided that I wanted to create the JLMN group, really driven towards that value creation thesis, return, impact, resiliency, and really helping companies, whether they're small, medium, large businesses, elevate their business paradigm, think differently, access capital, but also drive that into the intersection of what we're seeing in technology and AI. So very, very early days, and I'm just really grateful to be here to talk to you and to sort of do these breakout sessions in terms of what this will mean in the context of the case study. So thank you.
Thank you so much, Janice. And in order for us to introduce the case study, there are a couple terms, so we can do it like a rapid fire round. So let's say 1 minute on just each of these terms. If we can break them down, I'm going to make my questions as focused as I can. So Graeme, the first one for you, if you can differentiate for us how private market firms are different from public market asset managers.
Sure. How rapid fire do I have to be? So I mean, private capital is just an umbrella term for investment in privately held companies versus publicly traded companies. That's really all it means. However, what I will say is that private capital, and this has been in the news a lot, is playing an increasingly role going globally in terms of the worldwide investment portfolio. So in 1980, guess how many private equity firms there were in the world? Anybody have a guess? 28. Guess how many now? 9,200 with $7 trillion under management. And there's a tie-in here to pension funds as well. Private capital tends to be more nimble, has a longer investment horizon. They are efficient allocators of capital, so they're going to invest where they know they're going to get a return, which tends to spur innovation. And all of those things play very well into a sustainability narrative because really private equity is primed to really make an impact and drive some of these goals. And it's not for altruistic reasons, and I think we're going to get into maybe some deal examples. It's really because companies that are sustainable in a holistic way are better managed, typically have more revenue opportunity, more greater margins, and more exit options. So all important things to consider in our discussion today.
Thank you so much for that, Graeme. And Janice, we've spoken a lot about fiduciary duty today. And it has been explained how fiduciary duty and the environmental and social impact might come, in terms of a friction or a little bit of a conflict. But what I'd love for you to be able to share with us is, what does fiduciary duty mean at its core, if you can break the term down for us?
Yeah, sure. So when we think about fiduciary duty, it's been around for many, many years, and it really is there, or it exists because it's really designed to make sure that people who manage other people's money do so in the best interest of the beneficiary. So if we break that down, and honestly there are various definitions of that, and it tends to differ jurisdictionally, but really at the heart of it, and I think this is the common denominator in the term and its definition, is that there really are two duties. The first duty is one of loyalty, and when you think about loyalty, it's what is that investor doing honestly and in good faith to represent and do so with the beneficiary in mind, so the best interest of that beneficiary. And so that typically means issues around conflicts of interest, making sure that there's a sound balance between that, not only of the beneficiaries, but also of the person who's making those decisions. The second aspect of the duty is to ensure prudence. And when we think about prudence, that's really breaking it down into, making investment decisions with the skill, the judgment, the care, and the knowledge that a reasonable investor would do. And a reasonable investor would do that in the context of deriving return, financial return, but also appropriately ensuring that any potential losses are effectively mitigated. Now, when we think about impact investing, we need to clarify that actually an impact investment, number one, is intention-focused. So that means it's really driven to look at companies and business models that have an environmental and social benefit. And on the second hand, they're actually driving financial return. Now, it's either a return on the capital or the preservation of the capital that's gone into that investment decision. At no point is an investment or an impact investment one where there's a trade-off on that return. The return is based on a range of possibilities where at a minimum you've preserved the capital, and above all you can then return on that capital at market rates and beyond. So I think when we go into the investment decisions today and we think about the case study, it's going to be really important to sort of think through the factions that you're going to be looking at, recognizing those fundamental premises.
Janice, thank you so much. I think it gives us a very holistic framework to understand fiduciary duty. And from here, Graeme, it would be wonderful if you could touch a little bit upon SDGs and its connection with investment. So for example, we've got funds, and we'll consider them in the case study as well, that there are funds that are specifically focused on the SDGs. What does that mean? How are they connected?
Well, I think it was similar to what I was saying before, is that, there are a lot of needs in the world, a lot of them are around sustainability, and given there is a need, there is opportunity for investment. So I picked two deals that I wasn't involved in and two deals that I was, and hopefully it'll kind of draw it out for you. So The first one I was going to mention was in 2018, KKR invested in a company in India called Sustainable. Sustainable did all sorts of things around waste and waste management. They did municipal waste, industrial waste, medical waste, remediation services. The list goes on. They were in multiple markets: India, Singapore, Middle East, and Africa. All some of those emerging markets that we're about to do a case on. 6 years later, they're in discussion, and I think CPP might be involved in this one, to sell part of the business for, so the original investment was, $519 million. They're going to sell approximately half of the business for $1 billion. What does that tell you? It tells you that perceptions of value are changing based on the needs in the world today. The second investment example along the same lines, Ridgewood Infrastructure. It's out of the US. They are investing in water infrastructure in Texas and Florida through some EPA regulations that are going to tighten down on inefficiencies in the water system, lead and copper in that system. There's approximately a need for 130 to 300 million just to fix things. And there are a lot of little municipal players in the water system in the US that serve a lot of customers. And that's perfect for private equity because what they like to do is bring efficiency. So likely they'll make those investments and work to put a bigger umbrella around how they service customers and make their return that way. The two quick examples from my end, and this was a company very close to here. What they did was they designed automotive packaging, quote unquote. And what all that really meant was they put together racks to transport automotive parts between tiers of manufacturers. They were not pretending to be sustainable at the time of our involvement with them. And they did one thing from an environmental perspective. They took back their metal. That's it. Now, the effect of doing that was they had lower cost of materials. They won environmental rewards from global OEMs. They had higher inventory so it could turn around their programs faster and win more deals. And they had lower pricing because their material costs were lower. At the time of private equity investment, the EBITDA for that company, which is a measure of how much cash flow they make, it was approximately $10 million. Today, that cash flow is 30. It made the entire return for the fund, and the successes go on. The second example I want to draw the crowd's attention to is one from the other side. So this was a company that made an organic spread product. It's in your grocery store today. And it was bought by a US private equity firm. And they were very particular about how the product was made. It was an organic product. They had various environmental initiatives baked into manufacturing. However, they imported their glass from Europe. And all of a sudden, COVID hit. They had a very, very difficult time getting their glass, making their product, and I think at one point, EBITDA went to negative. They've since recovered, but it just goes to show how sustainability can weave its way through different aspects within a business that you don't normally think of.
Graeme, those are wonderful examples and quite insightful to see how those considerations actually had real-world consequences. And I loved when you actually put the numbers beside, this is what it was before, this is what it's after, so there is a seismic shift that you can visually appreciate. So from that perspective, because we're talking about private markets and private markets investors and how ESG is important, we see ESG committees being the norm in most private equity firms. But it would be wonderful, Janice, if you can share with us what an ESG committee's role is in a private equity firm?
Right. Well, I must say it's evolved. And, you know, we all want it to be the perfect answer, but the reality is that many ESG committees spend a lot of time in disclosure or looking and making sure that reputational issues are being effectively mitigated. The role, though, of the ESG committee is to work alongside the investment committees, the risk committees, and others who have a very clear view of the fiduciary responsibility to ensure that a holistic view of environment, social, and governance issues are really understood, well thought about, and informing the strategy for that investment thesis of the fund, let's say. And to do that, what it really imposes is a full understanding and the intersection that these ESG type of factors or considerations are very much hand in hand with the economic and the financial impacts. They spend a lot of time in, you know, articulating and helping to inform strategy, putting in place responsible investment policies, identifying and working collaboratively on the objective of that fund, let's say, and then even looking at it through the lens of performance to determine what types of metrics need to be measured to ensure that the fund is actually going to be able to deliver what it set out to do. Another very important role of the ESG committee is to really understand in a much more holistic view what are the risks and the opportunities through due diligence assessments, and what are those kinds of questions that need to be asked. And as many of you know, now we're in a world where materiality or impact assessing has become center stage. The IFRS, International Sustainability Standards Board, and others in Europe, now in Canada, are sort of rethinking what does materiality actually mean. And so within that context, a lot of these ESG committees are rethinking and trying to look into, you know, it's not just risk, it's opportunity. It's not just how does that environmental issue impact our business, but how do we as a business impact that environmental issue? And therefore, as the investment decisions are being made, that information is brought to bear. So ESG committees are spending a lot of time on that front. And then finally, of course, in the disclosure side, that for every fund or investment strategy, there's going to be a need to ensure that the disclosures are paramount and they're well articulated and they're done in a way that is very much, you know, there's no greenwashing, but very much aligned with the international standards to be. So it's a fairly big role. And, you know, to be honest, in the end, they too are held to a very high standard from a fiduciary standpoint and stewardship as well. So I think that's sort of a broad view.
Thank you so much, Janice. And this is the perfect segue into our case study. So if we could have the case study on the slide, if we could go on to the next slide, then we'll basically take the, sorry? Yes, on this. Oh, so that's in the other room. Okay, so my mistake. So what I'll do is I'll basically just provide a background, and then we can cover the case study in the breakout room. So essentially, all of the participants in this session are going to be picturing themselves being part of an ESG committee at a large private equity firm which has about $20 billion of assets under management. And the management and the board have decided to invest $1 billion into a Sustainable Development Goals, or SDG-focused impact fund. And the fund has a name and a focus to basically invest in emerging markets. So when we move into the breakout room, we'll go through the case study and the questions, and then all of the participants, all of you, are going to be sitting within groups to actually act as an ESG committee and how you would actually make decisions pertaining to your fiduciary duty. So we can all move on to the other room, and then we can continue this. Thank you so much.